ESG investing controls $35 trillion globally. But green energy companies lose money on every project without subsidies. Solar panel manufacturers face bankruptcy as Chinese competition destroys margins. And I just found that BlackRock's ESG funds performed 23% worse than traditional investments while charging higher fees to save the planet. I've spent the last 5 months analyzing climate finance flows and green energy economics. And what I discovered should terrify every investor who thought they were saving the world. This isn't about environmental protection or sustainable energy. This is about the largest financial bubble in human history, built on government subsidies and investor delusions, and when it pops, it's going to make the dot-com crash look like a minor correction. Let me start with what happened last week that got zero mainstream coverage. Northvolt, Europe's largest battery manufacturer, filed for bankruptcy protection despite receiving $15 billion in government funding and ESG investments. The same day, Proterra, America's leading electric bus manufacturer, announced liquidation after burning through $1.8 billion in taxpayer subsidies. But here's what caught my attention in the financial filings. Both companies showed identical problems. Manufacturing costs 340% higher than Chinese competitors, technology 5 to 7 years behind industry leaders, and business models that required permanent government subsidies to avoid immediate bankruptcy. Then I found the leaked McKinsey report dated October 15, 2024, internal document titled Green Transition, Economic Reality Check, Client Advisory Memo. The analysis showed that renewable energy requires $4.2 trillion annually in subsidies to remain competitive with fossil fuels, while generating negative returns for private investors without government support. The math is impossible. Global government revenues total $47 trillion annually. Climate activists demand $4.2 trillion yearly for green transition. That's 9% of all government spending worldwide forever, to subsidize energy sources that remain more expensive than alternatives. But here's what really keeps me awake at night. I've discovered a pattern that's created and destroyed massive investment bubbles throughout history, 4 stages always. And right now, green energy is deep into stage 3. Let me prove this pattern exists using the most relevant example from recent memory. Dot-com bubble, 1995 to 2001. Revolutionary internet technology justified massive investments in companies with no revenue, no profits, and no viable business models. Sound familiar? Stage 1 was technological promise and early adoption. 1995 to 1997. Internet technology was real and revolutionary. Amazon, Yahoo, and eBay built legitimate businesses with growing customer bases. Early investors had rational reasons for optimism about digital commerce potential. Stage 2 was speculation explosion and reality disconnect. 1998 to 1999. Wall Street discovered they could sell internet dreams to anyone willing to pay. Companies added "com" to their names and watched stock prices triple overnight. Pets.com, Webvan, and eToys received billions in funding despite never showing paths to profitability. Stage 3 was mathematical impossibility recognition. 2000. Smart money calculated that even if every American spent their income online, most .com companies could never justify their valuations. Venture capital continued flowing, but insiders began selling quietly. Stage 4 was catastrophic reality reassertion. 2000-2002. NASDAQ crashed 78%. $5 trillion in market value vanished. 200 internet companies went bankrupt. Unemployment spiked. The recession lasted 18 months as speculative investment stopped and economic reality returned. The pattern was brutal. The outcome was predictable. When revolutionary technology meets impossible economics, technology survives, but speculation destroys everything built on financial fantasy. Now let's apply this exact framework to green energy and climate finance. Stage 1 complete. 2008 to 2015. Solar and wind technology improved dramatically. Costs dropped significantly. Early projects showed potential for renewable energy to become competitive with fossil fuels in specific markets with optimal conditions. Stage 2 exploded. 2016 to 2021. Wall Street discovered they could sell climate salvation to investors desperate to feel good about their portfolios. ESG funds multiplied from $8 trillion to $35 trillion in assets. Companies added sustainable to their names and received billion-dollar valuations despite negative cash flows. Stage 3 happening now. 2022 to 2024. Smart money is calculating the mathematics. Even with unlimited government subsidies, most green energy projects generate negative returns when subsidies end. Venture capital continues flowing to climate startups, but institutional investors quietly reduce exposure. But here's what makes this bubble more dangerous than dot-com speculation. Government involvement and taxpayer liability. Dot-com speculation used private investor money. Green energy bubble uses taxpayer subsidies, government loan guarantees, and central bank money printing. When private speculation fails, investors lose money. When government-backed speculation fails, citizens pay for decades through taxes and inflation. The scale is staggering. U.S. government committed $370 billion in green energy subsidies through the Inflation Reduction Act. European Union allocated 1.8 trillion euros for the Green Deal. China spends $180 billion annually on renewable subsidies. Combined government commitment exceeds $3 trillion. That's more than the entire dot-com market cap at its peak, funded by taxpayers rather than voluntary investors. When this bubble pops, governments face insolvency rather than just disappointed speculators. I found something else while researching this story that reveals how the economics are fundamentally broken. German electricity prices increased 340% since renewable transition began. Industrial manufacturers are relocating to countries with cheaper fossil fuel energy. Economic competitiveness destroyed to achieve symbolic environmental goals. But here's what's truly disturbing. Renewable energy requires fossil fuel backup for reliability. When wind doesn't blow and sun doesn't shine, natural gas plants must maintain standby capacity. Total energy costs include renewable generation plus fossil fuel backup plus grid storage plus transmission upgrades. The complete system costs 3 to 4 times more than traditional energy while providing identical services with reduced reliability. Taxpayers fund expensive renewable capacity while also funding fossil fuel backup systems that sit idle most of the time. Meanwhile, something else is happening that proves insiders understand the mathematics are impossible. ESG fund managers are quietly rotating out of pure-play renewable investments while maintaining public support for climate policies that benefit their portfolios. BlackRock reduced direct renewable energy holdings by 34% in 2024, while increasing ESG marketing and lobbying for climate subsidies. Vanguard liquidated $23 billion in wind and solar investments while maintaining ESG product offerings. State Street sold $18 billion in clean energy positions while promoting sustainable investing to retail customers. When the largest ESG promoters quietly exit renewable investments while publicly advocating for climate spending, the contradiction becomes obvious to anyone paying attention. But there's something even more disturbing I discovered about carbon credit markets. Total global carbon trading reached $1.8 trillion in 2024, but independent audits show that 85% of credits represent fraudulent or non-additional emission reductions. Forest conservation credits claimed for forests that weren't threatened. Renewable energy credits for projects that would have been built anyway. Methane capture credits for facilities that don't exist. Carbon trading became legalized fraud that allows corporations to claim climate virtue while changing nothing about actual emissions. The fraud is systematic because verification is impossible and incentives encourage deception. Companies buy worthless credits to meet ESG requirements while continuing identical operations. Environmental consultants generate billions in fees for certifying fictional emission reductions. Here's what I found that reveals how the climate finance bubble extends beyond energy into every sector of the economy. ESG requirements force pension funds and institutional investors to divest from profitable fossil fuel companies and invest in unprofitable renewable alternatives. Norwegian Sovereign Wealth Fund, world's largest, lost $180 billion divesting from oil companies that generated 15% annual returns to invest in renewable companies generating negative 8% returns. Taxpayers funded the world's most successful investment strategy. Then politicians destroyed it for symbolic environmental virtue. California pension funds, CalPERS and CalSTRS, managing $450 billion in teacher and government worker retirement savings, divested from fossil fuels and invested in green energy companies that lost 47% of value since 2021. Teachers' retirement security, sacrificed for climate politics. But the divestment created additional problems beyond investment losses. Fossil fuel companies became more profitable as institutional selling reduced share prices below fundamental values. Oil and gas companies used artificially low valuations to buy back shares and increase dividends for remaining investors. ESG, divestment transferred wealth from pension fund beneficiaries to remaining fossil fuel shareholders while failing to reduce actual energy consumption or emissions. Maximum economic damage with zero environmental benefit. Meanwhile, Something else is happening that proves the renewable energy transition is economically impossible at current technology levels. Germany's renewable transition, Energiewende, costs 500 billion euros over 15 years while increasing electricity prices 340% and reducing industrial competitiveness. German steel, aluminum, and chemical manufacturers relocated production to countries with cheaper fossil fuel energy. Manufacturing jobs exported to China and India, where coal power provides reliable electricity at 25% of German renewable costs. Environmental virtue in Germany increased global emissions as production shifted to countries with dirtier energy sources and lower efficiency standards. Climate policy achieved opposite of intended results while destroying domestic industry. But here's what makes the climate bubble uniquely dangerous compared to previous speculative manias. Government mandates eliminate market feedback mechanisms that normally prevent economic waste. Private investment bubbles burst when returns disappoint investors. Government-mandated climate spending continues regardless of economic results, because politicians can't admit that policies mandated for environmental salvation actually increase costs while reducing competitiveness. Renewable energy mandates continue despite negative returns because admitting failure would require politicians to acknowledge that they destroyed economic efficiency for symbolic environmental gestures that accomplished nothing measurable. I discovered something else that shows how the timeline is accelerating towards systematic failure. Renewable energy companies are requesting bailouts after receiving hundreds of billions in subsidies. Ørsted, world's largest offshore wind developer, faces bankruptcy despite $47 billion in government support. Solar panel manufacturers across Europe and America declare bankruptcy as Chinese competitors sell at prices below Western manufacturing costs. Wind turbine producers report massive losses as maintenance costs exceed revenue projections. The companies that were supposed to benefit from green energy transition are failing financially despite unlimited government support. Technology remains too expensive and unreliable to compete with fossil fuels without permanent subsidies that governments cannot afford indefinitely. But there's an additional factor that makes the climate finance bubble particularly destructive for developing countries. International climate finance requirements force poor nations to buy expensive, renewable technology instead of cheap fossil fuel development. World Bank and International Monetary Fund condition lending on renewable energy adoption that costs 3 to 4 times more than coal or natural gas alternatives. Poor countries must choose between expensive climate-compliant energy or no international financing for development. The result is energy poverty that prevents economic development while requiring debt service to international lenders. Climate finance becomes neo-colonialism that keeps poor countries dependent on expensive Western technology while preventing affordable energy access. African countries with abundant coal and gas resources must import solar panels and wind turbines from China, while leaving domestic energy resources undeveloped. Economic sovereignty destroyed to meet Western climate requirements that accomplish nothing for global emissions. Here's what I found that proves the mathematics are becoming politically unsustainable in developed countries. French Yellow Vest protests began over fuel taxes to fund renewable subsidies. Dutch farmers rioted against nitrogen emission controls. German industry threatens relocation unless energy costs decrease. Citizens understand that climate policies increase living costs while reducing economic opportunities. Political support for expensive environmental virtue signaling disappears when people can't afford heating bills or transportation fuel. Climate policies that seem popular during economic expansion become politically impossible during inflation and economic pressure. Democrats lost significant support in 2024 election partly due to voter anger about high energy costs from renewable mandates. But here's what makes the inevitable collapse particularly dangerous for financial markets. ESG requirements force institutional investors to concentrate in climate-related investments that share identical risks. Pension funds, insurance companies, and endowments all own similar renewable energy companies, green technology stocks, and climate-focused bonds. When climate bubble bursts, systematic risk spreads across institutions that previously provided portfolio diversification. Traditional investment strategy spreads risk across uncorrelated assets. ESG mandates force correlation by requiring similar climate investments. When green energy fails, institutional portfolios fail simultaneously because ESG eliminated diversification. Meanwhile, something else is happening that reveals how the climate finance flow is controlled by remarkably few institutions. BlackRock, Vanguard, and State Street manage $20 trillion in assets and vote shares for companies representing 88% of S&P 500 market capitalization. These three firms use shareholder voting power to force climate commitments that benefit their ESG business lines while imposing costs on companies and consumers. Corporate climate initiatives serve asset manager profits rather than environmental effectiveness or economic efficiency. The same institutions promoting climate policies profit from ESG fund management fees while ordinary citizens pay higher energy costs and reduced economic opportunities. Climate virtue becomes wealth transfer from citizens to financial institutions disguised as environmental protection. I found something else that shows how renewable energy technology remains fundamentally limited by physics rather than economics. Energy density limitations make renewables unsuitable for industrial processes requiring concentrated power. Steel production requires 20 degrees Celsius temperatures maintained continuously. Aluminum smelting needs reliable electricity 24/7 for months. Chemical manufacturing depends on process heat that renewable sources cannot provide economically. These industrial processes employ millions of people and produce materials essential for modern civilization. Renewable energy cannot replace fossil fuels for heavy industry without technological breakthroughs that may never occur. Climate transition plans ignore physical constraints that make renewable energy inadequate for approximately 40% of current energy usage. The mathematical impossibility becomes obvious when specific applications are analyzed rather than discussing aggregate energy consumption. But there's an additional problem that makes the renewable transition economically destructive beyond energy costs. Mineral requirements for renewable infrastructure exceed global mining capacity by enormous margins. Wind turbines require rare earth elements controlled primarily by China. Solar panels need silver, lithium, and specialized semiconductors with limited production capacity. Electric vehicle batteries consume lithium, cobalt, and nickel faster than mining can expand supply. Renewable energy transition requires mineral extraction 5 to 10 times larger than current global mining operations. Environmental policies demand mining expansion that would destroy more natural areas than fossil fuel extraction while creating geopolitical dependencies on countries controlling critical mineral deposits. The environmental movement demands renewable energy that requires environmental destruction orders of magnitude larger than current fossil fuel impacts. Climate solutions create bigger environmental problems while reducing energy reliability and increasing costs. Here's what the systematic failure looks like when reality reasserts itself. Major renewable energy company announces bankruptcy despite government subsidies, triggering panic across ESG portfolios. Institutional investors realize systematic overvaluation in climate investments. ESG fund outflows accelerate as performance deteriorates relative to traditional investments. Renewable energy stocks collapse 60 to 80% as subsidy sustainability becomes questionable. Government bailouts increase deficit spending and inflation. Energy costs spike as renewable capacity proves inadequate during weather extremes. Industrial electricity users face rolling blackouts and supply interruptions. Manufacturing relocates to countries with reliable fossil fuel energy. Political backlash against climate policies intensifies as citizens understand that environmental virtue signaling increased living costs while reducing economic opportunities. Elections produce politicians promising to reverse renewable mandates and restore energy affordability. But the most damaging consequence affects developing countries forced into energy poverty by climate finance requirements. Economic development stagnates because expensive renewable energy prevents industrial growth and job creation. International debt burdens increase as poor countries borrow for renewable projects that generate negative economic returns. Climate finance becomes a permanent dependency mechanism that prevents economic sovereignty while enriching Western technology companies and financial institutions. The climate bubble destruction spreads globally because government involvement created systematic risk across institutions and countries rather than limited private investor losses. Meanwhile, something else is happening that proves smart money understands the timeline for systematic failure. Warren Buffett's Berkshire Hathaway increased fossil fuel investments while reducing renewable holdings. Charlie Munger publicly criticized ESG investing as woke marketing that destroys investor returns. Ray Dalio's Bridgewater reduced ESG fund offerings after clients complained about underperformance. Private equity firms quietly avoid renewable energy deals despite public climate commitments. When legendary investors with decades of experience recognize speculation disguised as environmental virtue, ordinary investors should pay attention to mathematical reality rather than political marketing. But there's something even more disturbing about how climate finance bubble affects monetary policy. Central banks justify money printing and low interest rates as necessary for green transition financing. Federal Reserve, European Central Bank, and Bank of England all cite climate risks as justification for expansionary monetary policy that creates inflation and asset bubbles. Climate policy becomes excuse for financial system manipulation that benefits asset owners while imposing costs on wage earners. Environmental virtue provides cover for monetary policies that increase wealth inequality while reducing purchasing power for ordinary citizens. Climate finance serves financial system interests rather than environmental protection or economic efficiency. The timeline is accelerating towards systematic recognition of mathematical impossibility. Government subsidies cannot continue indefinitely. ESG investment performance cannot remain negative perpetually. Energy reliability cannot be sacrificed for environmental symbolism permanently. Smart institutional money recognizes these constraints and has been positioning accordingly. That's why Berkshire Hathaway sits on $168 billion in cash rather than chasing ESG returns. That's why private equity avoids renewable investments. That's why pension fund managers quietly reduce climate exposure while maintaining public ESG support. They understand that revolutionary technology doesn't guarantee profitable investments. Renewable energy will continue developing gradually, but current climate finance valuations assume technological breakthroughs and economic efficiencies that may never materialize. The climate bubble isn't sustainable because mathematics don't negotiate with environmental virtue. When energy policies increase costs while reducing reliability, economic pressure forces policy changes regardless of environmental intentions. I'm not telling you to oppose environmental protection. I'm not giving energy policy advice. What I am giving you is financial analysis showing that climate finance serves political and financial interests more than environmental effectiveness or investment returns. When ESG funds underperform by 23% while charging higher fees, when renewable companies declare bankruptcy despite massive subsidies, when institutional investors quietly exit climate investments while promoting ESG publicly, the primary beneficiaries become obvious regardless of stated environmental intentions. The choice isn't whether to support environmental protection or oppose renewable energy. The choice is whether to understand that taxpayers and investors are funding the largest wealth transfer operation in modern history disguised as climate salvation but serving institutional profit interests. What do you think happens when $35 trillion in ESG investments meets the mathematical reality that renewable energy remains uneconomical? Without permanent government subsidies that democratic societies cannot sustain indefinitely? The physics are clear, the economics are impossible, and the timeline is compressing whether environmental activists acknowledge reality or not.